We'll start with accounting rules, chapter number 10. Under this topic, we are going to cover three content: principles, capital and revenue receipts and payments, valuation of inventory. These three aspects. So, accounting principles, capital and revenue expenditure, receipts, revenue expenditure and receipts, inventory valuation. Even you need to have an overview of international accounting standards. Accounting principles. While preparing the accounts, you have to keep all these principles in your mind for recording the transactions. The first principle being business entity principle. As per this business entity principle, business and owner are not being same. That's how we can consider, are treated as separate entities. Because of this reason only, any amount transferred from business to owner as well as owner to business will be treated differently. If the money goes from business to owner, it will be named as drawings. If the money introduced from owner's pocket to the business, it will be named as capital. Second principle is all about consistency. Whatever the accounting method you choose should be followed year after year, unless the requirement arises for changing. For example, if you follow straight line method of depreciation in a year, you better follow the same year after year. That is called consistency principle. We have duality principle also. Every transaction will have two aspects. One debit, another one is credit. You have to keep this in your mind. Accounting equation also comes as per this one rule. Purchase of goods for cash will affect goods as well as cash. The goods you have increases, the cash you have decreases. This will come under duality concept. Fourth principle being going concern. It is assumed that the business will continue in the future also. We don't have any intention to close. This is called going concern. Because of this principle only, assets are shown at cost, even we will reduce it to net book value after depreciating for the usage, not the liquidation value. So liquidation value means the company is supposed to be closed. While closing, the assets value is much lower than the value we record. Okay. And you have to follow the accounting principles. Historical cost, otherwise cost. The assets are recorded at their original purchase price. Okay. Building bought for 10 lakhs shown as 10 lakhs only. If you need, then you can subtract the depreciation. If the asset has a MRP being 10 lakhs, while purchasing you have enjoyed 2 lakhs trade discount, then actual amount you pay is only 8 lakhs, isn't it? We have to consider only 8 lakhs to be shown in our books, not this one. This is called cost. The actual cost you pay for the assets at the time of purchase will be the value at which you are going to show in your books. Matching principle. Every expenses you spend should match with the revenue for the same period. For example, if you are preparing for 2024, any accounts for 2024, find out the revenue for this period only and find out the expenses for this period only. And these two are matched, and finding the difference, if any, will be called as your profit or loss. Revenue for 2024 and expenses for 2024 will be the matter. Is that okay? Rent for 2024 charged against rent income under 2024. Okay. This is called matching. Materiality principle. Record only the items are significant to user's decision. Okay, significant, very important. See, if you purchase a calculator, the calculator will have 4-5 years life also. So if the payment gives you benefit for more than 1 year, it is usually asset, means capital expenditure. But your business size is voluminous, your transaction value is more than 10 lakhs, or 20 lakhs, but the calculator is only 100 rupees. Okay. So just 100 rupees, you don't show this being your asset because the value is very, very insignificant, immaterial. So this may be treated as expenses and written off immediately to your P&L account. That is called materiality. So you may see that some cases, Mr. X may treat all the payments below $100 is considered as expenses, though the payment gives you benefit for more than 1 year. This is due to materiality concept. Money measurement concept. Money measurement concept. Transaction measurable in money only recorded. For example, if you are purchasing the asset for rupees 1 crore, okay, then it may be recorded, but the registration for this involving no real cash flow will not be recorded. Registration, okay, and staff skill cannot be quantifiable in terms of money, so it is not going to be accounted. Appreciation, an appreciation given to a good performing staff without any cash award will not be recorded because these things are non-measurable in terms of money. Ninth one being realization concept. Especially this will be applicable for the revenue. Once the revenue is confirmed and you received or the receipt of this is guaranteed, only then it will be considered as earning. If there is any doubt, it should not be recognized. Revenue is recognized when earned, not when cash is received. The moment you supposed to receive or received, then it is your income. Sale recorded when goods delivered to customer, even though the money is not received. In that case, the customer will be named as trade receivables. Is that okay? Anyhow, this is your income only. Okay, so these are the 9 principles you have to understand. So 3 aspects are going to be covered predominantly. Apart from that, international accounting standard, we have covered the principles here in detail. So we have 9 principles. Clear? Now we'll move on to the next one. International accounting standards. Okay. What happens here? Why do we want to have a standardized format? For easy comparability between the financial reports prepared by entity A as well as entity B, or the financial reports prepared by entity A in the year 2024 compared with the financial reports prepared in the year 2025. For the comparability, this standardization is required. So because of that only there is international accounting standard. Relevance. Information must be useful for the users. So unless you prepare the data for the users, then what is the use at all? Okay. Showing current year's performance helps investors decide whether this company is good or not. That's what about relevance. Comparability, same accounting methods used each year for easy comparison. For example, straight line method of depreciation, if you have to follow the same year after year. That's how the accounting standard says, international accounting standard says. If you follow the same method year after year, you can easily compare between 1 year to the next year. And reliability. Whatever the information you get, it will be more accurate and complete and free from bias and error. Because of that reason, you can easily compare, the verified invoices, not estimate. So it can be a real one, not just because of an estimation you record. Understandability. Information should be clear and easy for the users. Okay, even if you don't have the accounting knowledge, because financial report is very important for all the users. So a Pakka presentation gives the easy understandability. It should be in simple language, proper heading and clear layout. So this is what about the requirement of international accounting standards, right? Second set is over, but third set is most important for your examination. So accounting principle, international accounting standard, inventory valuation. These are the 3 predominant aspects you have to be careful so that you can score good mark in your examination. These 3 are most wanted, okay, for your examination purpose. Let's start with this one, second aspect. Capital and revenue expenditure and receipts. Okay. Capital represents long term. You will get the benefit for n number of years in future. Revenue means short term. The benefit is within 1 year you can enjoy. And expenditure means outflow, receipt means inflow. Okay. So In case of receipts and payments, whatever it may be, okay, payments, otherwise expenditure. The receipts can be classifiable into two, okay, capital expenditure, capital receipts, revenue receipts, and payment also be classifiable into two, capital payment, capital expenditure, and revenue expenditure. Okay, that's how we can classify. Is that okay? Capital receipts, revenue receipts, and in case of expenditure, capital expenditure and revenue expenditure. Capital means you get the benefit for a longer period. Revenue related will be only for the short period, means you can enjoy the benefit or work for that within 1 year itself, 12 months itself. Let's see. Capital expenditure. Let me define all these things. Capital expenditure. Money spent to acquire or improve any long-term asset. For this, you purchased what? A machinery, or you have constructed a building or building extension. Because of this, you get the benefit for a longer period. Then it will be shown as an asset. This will be an asset. Capital expenditure being an asset. In case of revenue expenditure, it's related to the day-to-day operational expenses to run the business and maintain the existing assets. Any assets you have, any repair arises, you can spend money for repairing that. That will be coming under revenue expenditure. And the revenue expenditure being wages, rent paid, repairs, electricity. This is the asset, and for maintaining those assets, you will spend the repairs and you spend the electricity to run the machines. And apart from that, to operate this, we need to have laborers' wages, space, rent. So these kinds of payments are called revenue expenditure. This will be shown as expenses in the income statement. Third being capital receipts. Income received from non-trading or long-term source. That's called capital receipts, by selling the asset, like sale of fixed asset, issue of shares, loan taken. All these things are the capital receipts, and usually shown on the liability side or deducted from the asset side. So these are the two things may happen. It will be an item to be recorded in the financial position statement. Usually capital expenditure also be shown in the financial position statement. Okay, that too, in case of capital expenditure, it will be shown in the financial position statement, either asset side, or this will reduce the liability side. Okay, in case of capital receipt, okay, this will increase the asset or decrease the liability. In case of capital, liability means liabilities and capital. In case of capital receipt, this will be shown in the liabilities, otherwise increases the liabilities or decreases the assets or asset. Okay, that's what about the capital assets. In case of revenue receipts, income earned from normal business operations. Cash from sales like commission, rent received, all these things are the examples for the revenue receipt. Usually this will be shown in the income statement, P&L account. That it will fall under income side, this will fall under expense side. These two are in financial position, will affect the assets and liabilities. Clear? Hope you will be now able to understand the second block also. Second predominant, actually third as per our order, but anyway, if you skip, you have to be careful with 1, 3 and 4 only. We have completed the third one, means second one for us. Let's move on to the last one, inventory valuation. How do we value the inventory? Inventory valuation. Usually, you have to find out the cost for the inventory. Find out what could be the net realizable value if you sell. Comparing these two, whichever is lower of these two, okay, will be inventory value. Cost, say 100, and net realizable value. In short, I name this being NRV, net realizable value. The net realizable value being 80. Now tell me, what is the value of your inventory? Between these two, whichever is lower of these two will be taken. What is that value? 80. Suppose cost being 100, NRV being 105. What will be shown in your book? 100. Is that okay? Now you have to understand what is called cost. To make you understand cost is nothing but amount spent for buying and keeping that in your godown. Cost, after purchasing, you have to bring to your godown. No, for that you spend the money for carriage, transport, freight, whatever it may be. Add all these things, that will be the cost. What about the NRV? NRV, see, you have the shop here. If you are purchasing, the cost of the unit being 100 per unit purchased, To bring it from here to your godown or your showroom cost us another 5 rupees. Now what is your cost? 105. This is your cost. Sometimes later you will be selling this to the customer. While selling, you will sell it for 120. But he says that, sir, deliver to my place. So now I have to deliver that to his place, and the agent comes and demands some commission for that. So the commission as well as carriage outward, this will be called as carriage outward. This will be called as carriage inward. So commission being 5 rupees, carriage outward being 10 rupees, carriage outward being 2 rupees. So 7 rupees I have to incur. I get 120 rupees from my customer, but I need to spend 7 rupees for selling. Ultimately, I get how much? 113 rupees in my hand. So the cost being 105, NRV being 113, the value at which you are going to show in your book being 105. Cost or NRV, whichever is lower. So in case of NRV, the amount you recover from the customer by selling, from there any cost to complete this one before you sell, no, that will be subtracted. The ultimate value will be the NRV. You compare these two costs, between these two, lower of that will be your inventory value. Clear? Hope you will be now able to understand the theory of all the three concepts. Now, what happens here? Principle related illustrations we are going to see. 1, 2, the two questions asked in the examination carrying 1 mark and here 3 mark each, related to the principle related. So the principle we have seen, no? Business entity, consistency, duality, going concern, historical cost, matching, materiality, money measurement and realization. So in those from those principles you can answer this. Going concern concept requires Saira's financial statement are prepared under the assumption that her business will continue for an indefinite period of time. So what is the intention? Run this business for indefinite period. Now what is the assumption? This is called going concern concept. Now the question is, so this is what about the going concern concept. Okay. Going concern concept. As per the going concern concept, business is assumed to continue in the future. Now, state why each external users of accounting statement would be interested in Saira's business continuing indefinitely. So, who are the users? Bank manager, government, trade payables. Saira prepares financial statements, means income statement as well as financial position statement. These statements are used by bank manager, government, trade payables. Not only that, sometimes even employees. So employees will demand a salary hike or bonus based on the better performance of the company. Similarly, the bank manager will demand this one to check whether their capability to repay the loan proper or not. So he will just check whether repayability is possible or not. For the government, government wants to know what is the tax amount recoverable and will he be able to, Saira can pay the tax or not, also be discussed or verified. For the tax trade payables, they will simply check their amount is repayable promptly or not. So these are the intention of them for reading the financial statement. So for that purpose only, financial statement should be prepared as per the going concern concept. Now, name the accounting principle. Shiv should apply when recording $900 he had used for a family holiday. Okay, family holiday. Family holiday cannot be recorded in your books. It means from the business, the amount spent for his personal purpose. If the money is used for personal purpose, this will be drawings. As per what concept? Separate entity concept or business entity concept? Business entity concept. Is that clear? Two questions we have discussed. Now we will move on to the capital expenditure and revenue expenditure content. Okay. Capital expenditure and revenue expenditure. already we discussed. Capital expenditure related to spending gives benefit for future years. Revenue expenditure, spending gives the benefit only for the current year. Very simple. Joss owns printing business and has recently incurred various expenditure relating to her premises required. Complete the table by inserting a tick to show how each item of expenditure should be classified. Okay, the first one has been completed as an example. Right, let's move on to the next one. Rates and new extension. Any new extension carried over for your building, unless you pay the tax. Okay, the tax being the regular expenses you pay. Once you purchase the new building, it's your duty to pay the tax month after month or year after year, depending upon the situation. So it is the amount spent for the assets, then it will be a revenue expenditure. Carriage cost for roof tiles for extension. Now come on, tell me, why do I purchase the roof tiles? For the new extension. New extension is nothing but an asset. Okay, unless you purchase the roof tiles, the new extension not possible, and roof tiles will not come from the supplier's point to your point automatically unless you spend the carriage cost. It will not come. So you are incurring the carriage cost and traveling cost, transport cost, whatever it may be. That is also forming part of the extension only, the asset only. Asset only means capital expenditure. Capital expenditure. Legal cost for new extension. When you go for the new extension very first time, okay, what are the expenses you incur to make the new extension usable, including the legal expenses you pay for registration purpose, also consider as capital expenditure. Legal expense. Unless you register the new extension in your name, you are not being the owner legally. So unless you spend this, you are not owner, means it is not considered as a revenue expenditure. It's a part of capital expenditure. Repairs to office roof. Office roof already you have. Okay, now and then you need to spend money for repairing this. So amount you spend for repairing this is nothing but maintaining the assets only. Any expenses paid for maintaining will be revenue expenditure. So you can score 4 marks for the 4 questions. Very simple illustration. Let's move on to the next illustration, the same one. Painting the walls of the storage area. This is already existing one. Painting will be done now and then very often. So revenue expenditure. Shelving for the storage area. Okay. Now you are making the shelf and all in the storage area. Okay. This is one time and will get the benefit for a longer period than capital expenditure. Installation of shelves, right? Capital expenditure. Unless you make the shelf and other things ready, that storage is not sufficient enough to store all the materials. It's not proper to store. Light fittings for storage area. Light fittings, capital expenditure. So you are constructing a storeroom where you have lots of shelf and you have the light, okay, installed. After getting all this set, then the storage becomes your asset. So the construction, lighting first time and shelves, all these things are related to the capital expenditure only. And what about the light bulbs for storage area? Very first time means it's a capital expenditure. But if you are replacing existing fused bulb, then it will be revenue expenditure. It's your, there will be a choice on that, okay. If it is being the first time and costly, but if it is insignificant, of course you can consider this being the revenue expenditure based on the materiality concept. Okay, hope you'll be able to understand this one. Move on to the third one. Stella had an extension to her premises built during 2023. The extension will be used as an office. Okay, so premises built and extension will be used as an office. Please tick the correct box. Okay. Legal fees for obtaining permission to build the extension. Without legal permission, this is non-operative. Once you get the permission, you can use it for a longer period. So, capital expenditure. Building cost for extension, capital expenditure. Insurance for the office. Okay, insurance for the office, you do it regularly. then revenue expenditure. Painting the office extension, first time painting. Okay, you are just now constructing, and you, after completing the construction, you are painting, then capital expenditure. But existing extension, if you existing building, if you are premises, if you are painting that, then that's a revenue expenditure. Office calendar for 2023. Office calendar for 2023 being the revenue expenditure. Okay. And purchase of office equipment. Purchase of office equipment. Office equipment asset, no, capital expenditure. And installation of office equipment related to asset only, capital expenditure. Stationery for office, revenue expenditure. Stationery for office, revenue expenditure. Hope you will be now able to complete the table by placing a tick to show how Nala should treat each item of her expenditure. Computer, printer, paper. Paper is a regular. You purchase now and then to consume this, so revenue expenditure. Computer equipment is an asset, so capital expenditure. Installation of computer equipment, unless you install the computer, is non-operatable, so capital expenditure. Motor vehicle asset, so capital expenditure. Insurance of motor vehicle, you have to do the insurance periodically, so revenue expenditure. Delivery of motor vehicle, you purchase a motor vehicle, it should get delivered to your place for usage. Any cost you spend to bring it to your place, like carriage in, also be considered as capital expenditure. So 4 marks. Clear? Now, third block, inventory valuation. When we discuss about inventory valuation, the main point to be kept in your mind being cost or NRV. Cost or NRV. Between these two, lower will be taken. Lower of. Grace buys handbags for $14 and sells them for 27 each. Okay. Grace buys for $14, sells for $27. Grace counted her inventory of handbags on 31st March 2025 and found that she had total 255 handbags. How many units she has? 255 bags she has, numbers. 15 handbags needed to be cleaned before sale. Out of that 15 bags, okay, needed to be cleaned before sale. And Grace needed to pay a total of $21 to have them cleaned. So, before sale, she has to spend how much? 21 rupees, $21 she has to spend. She expected to sell them for 25 each. What is the sale price? $25 only. Okay. So 25 into 15 bags. 25 into 15 bags. What is the value you get? 375. But you have to incur $21 for cleaning up. You subtract this $21. Come on, tell me what's the value? 354. Okay, this is the value for 15 bags. You have how many bags? 255 bags. Out of that, 15 bags will be valued at this rate. NRV. This is NRV. Okay. What about the cost? Cost being 14 per unit. Cost being 14 per unit. For 15 bags, what is the total cost? 210. Between these two, whichever is lower or lower of these two will be taken. You have to take $210 out of 255 bags. 3 handbags had become damaged. Grace could not repair these handbags and decided to sell them for 13 each. Another 3. Though the cost be, here the cost per bag is 14. Here the cost per bag is 14. But it can be saleable only for what rate? 13 each. 13 each. So now between these two, cost or NRV, whichever is lower will be taken. 13. How many bags are there? 3 bags. So the total value being $39. Clear? Rest of the bags, how many rest of the bags we have? 255 minus 18, 237 bags we have. The cost being 14 and sale value being 27. Nothing stated means sale value being 27. Between these two, whichever is lower, 14 will be taken. So 237 into 14, the final value being $3318. The total value being, okay, 1 second, 237 into 14, 3318. Then total being, now inventory valuation, cost or NRV. You have to take the lower of these two. Grace buys handbags for $14. Okay. This is the cost. And sells them at $27. This is the sale value. Grace counted her inventory of handbags on 31st March 25 and found that she had total 255 handbags. How many handbags she has? 255 handbags. Right. 15 handbags needed to be cleaned before sale. 15. Okay. Number of handbags. It requires cleaning. Now what is the cost? Cost being the same 14. What is the NRV? How do you calculate NRV? Sale price minus expenses for selling. Okay. Sale price being 15. But she could not sell. She has to spend $21 to clean. And then the sale price is also not 15, 25. The sale price of these handbags being $25. Now, what about the cleaning cost? 21 in total. Total means for 15 bags. Then divide this by 15. What is the cleaning cost per bag? 1.4. 1.4. Okay. From this 15, 1.4 is subtracted. The final sale price being 23.6 is the NRV. Now you compare 14 and 23.6. Between these two, lower value will be taken. What is the lower value? 14. What is the total value then? 15 numbers. 14 is the value of inventory. And for the total 14 into 15, you have to multiply. So the value being 210. Clear? 3 handbags. Another 3 handbags. Damage. Grace could not repair these handbags and decided to sell them for $13. Okay. Cost being 14. Because of the damage, she could sell for only 13 per bag. That is what about the NRV she could realize. Between these two, whichever is lower will be the final value for the inventory. 13 into how many bags she has? 3. So 13 into 3, 39. And balance how many bags she has? Total 255. No. 15 requires repairing. 3 could not be repaired and sold as it is. So after subtracting these two, how many bags she still has? 227 bags she has. And the cost being 14. What about the rest? Nothing stated means the usual sale price $27 can be considered as NRV. Between these two, whichever is lower, 14 can be taken. Here 13, here 14. Okay. 14 into number of bags available here being 227. So you multiply 14 and 227, the value being 3178. 3178. If you add up the 3, the total value being 3567. Once again, 227 into, not 227, I think there's an error here. Okay. 255 minus 15 minus 3, I think. Okay, this is 237. 237 is multiplied with 14, then final value being 3318. Total being 210 plus 39, 3567. Okay. We'll now go for the second question. Loti sells 3 different types of goods. Her inventory at 30th April 2024 is as follows. A. 30 inventory, purchase price being 14, net realizable value being 20, carriage inward is part of the cost of the unit only. Then the cost could be, what could be the cost? You have to add the purchase price and carriage. So 14 plus 1, 15, 17 plus 0, 17, 21 plus 2, 23. Now what is the value of stock? Value per unit. You have to compare cost and NRV. Between these two, lower will be taken. Okay, 20, 15. So you have to take 15. 24, 17. You have to take 17. 22, 23. You have to take 22. How many number of units we have? 60, 85, 30. So you have to multiply the number of units with the value per share per unit. Then inventory value total. 60 into 15, 900. 85 into 17, 1445. 1445. 30 into 2, 30 into 22, 660. Now I am going to add up all the three values. 900, 1445 plus 660. 3005 will be the inventory value. Next question. Question number 3. Nala is a trader who buys and sells stationery. She provided the following information. Number of units there, cost per unit, carriage inward. So you have to add up these two to find out cost. Selling expenses per unit, selling price. Any selling expenses that should be subtracted from the selling price to get the NRV. So cost being, I'll write the cost here. Cost being 4.5. 5.5 plus 1, 6.5. 4 plus 2, 6. 3.5 only. Okay. Cost plus carriage in. But what about the NRV? NRV is nothing but selling price per unit subtracted with selling expenses per unit. 8 rupees minus 0, 8 rupees. 10 minus 1.5, 8 rupees 50. 5 remains 5, 6 remains 6. Then what about the value? Between these two, lower will be taken 4.5. Between these two, lower will be taken 6.5. Between these two, lower will be taken 5. Between these two, lower will be taken 3.5. Now what about the total inventory valuation? You have to multiply the 4.5 with the 240 units. Okay. 1080. You have to multiply 6.5 with the 225 units. you will get 1462.50. Notepads 150 units multiplied with 5, 750 rupees. In case of boxes and pencils, you have to multiply 96 with 3.5, 336. The overall inventory value in this case being 3628.50. Calculate the value of Nala inventory at 28th February. This one carries 5 marks. 1 mark, 1 mark, 1 mark, 1 mark, and for this also 1 mark, 5 marks. State accounting principle used to value inventory. What principle we used here? We used here prudence principle. Prudence principle we have not discussed, I have not listed here. Anyhow, you can incorporate that one also, prudence. Okay, in case of doubt arises, how can you value? Okay, in case of doubt, you should always value conservatively. Conservatively means lower of these two. You have to be double cautious. That is called prudence principle. So you can include the prudence principles also in this chapter.